Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Happy Thursday, everybody. First up, yesterday, Wednesday, Beijing's General Administration of Customs published official trade data, which is typically fairly reliable as it can be verified with trading partners. China's trade performance in July was a pretty mixed bag. Exports grew by 7% year-on-year off a very low base, much less than the June 8.6%, underscoring the vulnerability of the Chinese economy to changes in external demand. Xing Zhaopeng, senior China strategist at ANZ Bank, told clients, quote, "Judging from the current situation, external demand is weakening. Even though momentum is still strong in the electronics sector, the cooling of overall manufacturing activity will definitely affect trade," end quote. David Chu of Bloomberg Economics similarly explained, quote, "China's unexpected export slowdown in July suggests foreign trade, the recovery's key prop last quarter, may lend less support to Q3 GDP. The result is particularly concerning given the weakening outlook for the US economy, highlighted by the recent jump in American unemployment. Together with weakness in China's retail sales, the trade data reinforce our view that 2024 growth is likely to undershoot the official 5% target unless more effective stimulus is adopted," end quote. Others are more optimistic, however. Erica Tay, an economist at Maybank, expressed in a note, for example, quote, "The overall export number is firmer than it seems," end quote, adding, quote, "The export recovery remains very much intact," end quote. We will have to see in the coming months which analysts are correct. Exports growth to the Association of Southeast Asian Nations region, China's biggest trading partner, slowed to 12.2% in July from June's 15%. Shipments to the European Union and the US, which recently raised tariffs on some Chinese-made products, sped up to around 8% in July as merchants rushed to deliver products before more punitive measures are introduced. Now, the imports data were more promising. In July, imports rose 7.2% versus an expected 3.5% rise, and versus last month's very poor 2.3% decline, showing positive signs about demand. China's trade surplus was $84.65 billion in July, down from $99.05 billion in June. China is relying heavily on trade which itself is built on subsidized industries, to maintain growth, and China's other growth drivers remain under tremendous strain. Larry Hu, head of China economics at Macquarie Group Limited, told clients in a note today, quote, "For Chinese policymakers, their bottom line is to defend their growth target. If China can no longer rely on export growth, they're going to switch back to domestic demand," end quote. Next up for the economy. Chinese financial media outlet Yicai reports that rental yields, that is the income generated by rental property relative to the property's value, are rising above bank deposit interest rates in China. Economists argue that this might encourage investors to purchase properties in order to get a stable return and at the same time bolster the country's housing prices. Quote, "Deposit yields in China have sunk below 2%. 6 state-owned banks trimmed their deposit rates on July 25th to 1.75% for 3-year fixed deposits and 1.8% for 5-year fixed deposits," end quote. According to the Zhuge Real Estate Data Research Center, both rental and housing prices have been sliding in 50 key Chinese cities in the past few years, and the drop in property prices has been much greater than that in rental prices. As a result, the average annual rental yield in these major cities climbed to 2.03% in the first half of this year, a new high since 2019. Bo Wenxi, chief economist for IPG China, told Yicai, quote, "Overall rental yields outperforming deposit interest rates should have a positive impact on the real estate market," end quote. However, he adds that cities' rental yields are still far below the level considered to be worthy of investment. In general, across the globe, only properties with rental yields above 5% are considered to generate a good return through renting out. Cities with rental yields below 3% have high property prices, making it hard to recoup costs through leasing. In addition, Yicai writes, China's rent-to-price ratio, which is the ratio of home prices to annual rent, which is used as an indicator of whether the housing market is fairly valued, is still high compared with other parts of the world, at 1 to 590. International standards suggest that a healthy real estate market should have a rent-to-price ratio of about 1 to 200. Property in major cities is generally expensive, which suppresses rental yields, the centre said. The rental yield in China's 4 first-tier cities, namely Beijing, Shanghai, Shenzhen and Guangzhou, was 1.79% in the first half of this year. This all indicates that while rental yields are higher than interest rates, neither are particularly attractive investments. We note too that the CSI 300 benchmark stock index is down 16% year on year and down 8% over the last 5 years. That is to say, there are not many good places households can park their money in. Quote, "For decades, interest rates in China were much higher than China's extremely low rental yields, which among other things meant that it made more financial sense to rent an apartment than to buy one. Unless, of course, you were certain that property prices would rise rapidly. Rental yields are now around 2%. This is still very low, but it's a record for the Chinese property market. Meanwhile, deposit rates are 1.75 to 1.8%. For the first time in a very long time, rental yields exceed the deposit rate. Of course, this doesn't mean that buying an apartment is now a better deal than saving money in the bank. Property is very illiquid, and property prices are declining, so it almost certainly still makes sense for Chinese households to buy government bonds rather than property, and use the interest earned to pay rent. But at least it is no longer the case that the only justification for buying rather than renting is an expected infinite surge in property prices." End quote. Next up for the economy. According to preliminary figures released yesterday by the China Passenger Car Association, for the first time, more than half the vehicles sold in China during July were either electric vehicles, EVs, or plug-in hybrids, a milestone in Beijing's efforts to transition the country to electric cars. However, there was a negative side to the numbers, from a growth perspective that is. There was a fall in the overall number of cars sold, again, like the export numbers we just covered, suggesting weakening demand. According to the numbers, sales of electric and plug-in hybrid vehicles, which are counted under the category of new energy vehicles in China, rose to 879,000 units, making up 50.8% of total sales in July. However, overall new vehicle sales dropped 2% to 1.73 million in July. As US-based Bloomberg writes today, the drop is part of a larger indication that spending on autos is slowing in China. In the first half of 2024, spending on cars was down about 1.1% from a year earlier. The State Economic Planner and Financial Ministry last month unveiled additional funding to boost consumption, including doubling subsidies for trading old cars in for new ones to 20,000 yuan, $2,800. Meanwhile, speaking of cars, XPeng Aero HT, a flying car subsidiary of Chinese electric car maker XPeng Inc., has secured $150 million in new funding as the company pushes forward to start mass production. Chinese financial media outlet Caixin writes today that XPeng Aero HT hasn't named the investors in the latest funding round, but learned that the financing was coordinated by the Guangzhou government, with at least 3 state-owned companies participating. XPeng Aero HT's post-investment valuation now exceeds $1 billion. So once again, we can see China's classic industrial playbook at work. Caixin explains that XPeng Aero HT's latest funding round is the largest in the industry so far this year. Its previous fundraising was completed in late 2021, securing more than $500 million from investors including IDG Capital, 5Y Capital, and XPeng, the parent company. XPeng Aero HT is one of the leading players in China's burgeoning electric vertical takeoff and landing market, as regulators step up support to the emerging business. In October, the company unveiled the concept of a detachable flying car model, the Land Aircraft Carrier, which adopts a split-body design featuring an extended range hybrid vehicle that serves as the ground carrier and charging base of a 2-seat helicopter-type aircraft. The fully electric aircraft can be detached to fly in low-altitude airspace. The Civil Aviation Administration of China in March accepted the Type Certificate application for Xpeng Aero HT's electric vertical takeoff and landing vehicle body. A Type Certificate is granted after the aircraft's design is approved, clearing the way for the vehicle to obtain an airworthiness certificate for commercial use. Next up, we have one more development to cover, but just quickly, if you're getting some value from today's episode, don't forget to the like button. Sharing, liking, and subscribing are all big helps. Thank you so much. Last week, we examined a piece by the president of the Institute of International and Strategic Studies at Peking University, Wang Jisi, called "Does China Prefer Trump or Harris?" Today we discuss how China is reacting to the election, but from the perspective of a US commentator. Ian Bremmer is the president and founder of Eurasia Group and G0 Media, and to end today's video, we examine a piece he penned this week called "China Watches America's Topsy-Turvy Election." We now quote selected excerpts from the piece directly. How will the Chinese Communist Party leadership react to the highly unpredictable US election? Chinese leaders are convinced that one of the few points America's Republicans and Democrats agree on is the desire to stunt China's natural growth and legitimate expansion of its influence. The two parties, Beijing believes, disagree only on which economic political weapons to use and how and when to use them. This view from Beijing should come as no surprise to Washington. After all, President Biden followed Trump's time in power with new tariffs, new technology restrictions, and an expansion of anti-China alliances with partners like Japan, South Korea, Australia, and even India. But it appears China's preparation for change in Washington center on adapting to meet the challenges created by a second Donald Trump presidency. For now, Trump remains a slight favorite to win the US election, and Beijing knows that early preparation is more critical for a new Trump administration than for a Harris presidency. At the moment, Beijing's desire for stability, both in relations with Washington and in the international system more generally, remains strong, because China's economy is slow to re-emerge from the traumas inflicted by draconian lockdown policies during the pandemic. Officially, Chinese officials say that the closure of US markets, more likely if Trump is returned to the White House, would force an intensification of China's bid to build the strength of its own consumer markets and a shift toward other foreign markets. For now, China seems unlikely to escalate a trade war it sees as likely, though. The biggest worry is if Chinese leaders decide that the limited engagement strategy of the past year hasn't produced good results, and that the next hostile US president will always be one election away. If so, China might respond to Trump or Harris administration economic pressure with a more assertive security policy. If the US really does become more aggressive in decoupling from China's economy, Washington would have less leverage to pressure Beijing to back away from its military and diplomatic pressure campaign against Taiwan. China could also adopt a friendlier approach, designed to make action against China less politically popular in the US. If Beijing pledged to invest in production and job creation on US soil, and if it negotiated a deal to limit global market expansion to some mutually agreeable level, Beijing could create new leverage to influence the future of US policy. The most likely scenario for 2025 is a period of tension in which China's leadership and a new administration in Washington weigh each other's strengths and weaknesses. Perhaps the best each side can hope for is that ongoing economic uncertainty in both Washington and Beijing will boost a pragmatic limiting of future damage to the world's most important bilateral relationship. Here ends the direct quote in today's episode of China Update. Let me know what you think of Mr. Bremmer's observations in this piece, as well as what we covered in the first half of the economy. That's today's episode of China Update. Thank you so much, everybody, for watching. Have a good Thursday, and I will see you all tomorrow.